we have to talk about one more thing, and this thing is related to our capital structure. Because until this point, I just said that we need corporate bonds. So that was a really simplistic assumption that we don't need any additional funding. We need just 1 million euros, and after that we will be living happily. But we have other opportunities. So obviously we can issue equity as well. So we had the chance to say that I don't want to issue bonds because in this case we have to pay interests, and in this case we have to share our profit with some bondholders. Okay, this share will be just 4 million euros, but still we are losing this. So in this case we can ask the question that, okay, but what happens if we are using equity? So this is the question when we have different kind of equities. So if we are checking the case study from then we can see that already SpaceX was supported by the Commercial Resupply Service program. It meant for them that they get contracts from NASA, actually after 2008 and for the second term after 2016, that if you deliver to the International Space Station a defined amount of cargo at a defined amount of price, then you will get a defined amount of money. So practically what happened here in the seeding capital program, that they defined number of sold goods at a defined unit price. So practically they stabilized the market for SpaceX, and also for the Orbital ATK, which then was merged into Northrop Grumman. So these companies, we cannot say they were subsidized because it was also their risk to live from this revenues, because at the same time nobody cared about their expenditure side. So if you are not able to fit your launch platform, and not just the rocket but also the cargo vehicle, so you need some kind of spacecraft, which is not part of this case study, then you will suffer losses and it will be bad for you. So the seeding capital program just focused on orderings and specifications, which is still really good, because after that you can say to investors that, okay, this is the lowest level of revenues what we can generate. Obviously, you can get some technological support from NASA. They will certify your rockets, so they will be part of the development process. But still, after that, once the rocket is developed, then you can use it on your own objectives as well. So it's just not mandatory. They don't have any monopoly to use this only to supply the International Space Station. You can launch satellites with this. So obviously you can increase your launch numbers on the commercial market, not on government market. And even you can ask for higher or lower unit prices. It's up to you. So because cargo to an International Space Station, since it uses a cargo vehicle, then it will be higher because of you need a spacecraft. If you just launches satellites, then you can have lower price tag because you're not using spacecraft. So that's why seeding capital can be really important, because it can secure the market, that it can stabilize everything for us. But unfortunately, the European Space Agency is not doing this yet. So So did not provide any specifications. There is no such a specific program which should have such a depth, unfortunately. So yeah. Then, if your friendly space agency is not so accommodative for you, then you can have other opportunities, and these other opportunities can be venture capital investors. So if you are looking on SpaceX data sheet, so SpaceX was founded in 2002, March, on Pi Day, and really funny because in this year they launched the third integrated flight test for spaceship. So, and then the super heavy. So yeah, they celebrated on their own beautiful way. Okay, but we can see that they started their operations in 2002, and first venture capital funding arrived once they get the NASA contract. So they get the Commercial Orbital Transportation Services contract, and then they were selected into the Commercial Resupply Services. So this is what I mentioned, that now you have a market. Now this was the appetizer for investors, because now this Funders Fund LLC purchased convertible preferred stock. So it's practically they were able to get nice 20 million US dollars. So it's cute. Also, we can see another venture capital. So that was a venture capital investment for 10 million US dollars. Still the same venture capital investment, less than 1 million US dollars. Then another one with 50 million US dollars. Draper was really happily buying themselves into them. Also, so we can see that in each year Draper came back with some money. Fidelity is much more, it's a pension fund. So we can see that it's not just venture capital, but preferred stock. So it means that it pays earlier. Practically, it's much more like a bond. So if you have any kind of revenue, then they will be paid. So now we can see that the sum of investments started to increase. Undisclosed firms, still venture capital equity investment, venture capital equity investment. That was the first year when they were able to reuse the first stage once it landed. So that was when they solved the technological problem. Now we can see a significant jump in terms of investment. So from 10 millions, we are jumping to 300 or 100 millions territory here. And also this is my favorite here. Ontario Teachers Pension Plan Board. Why not to buy, invest, or teachers pension fund into orbital launch businesses? So, and they are highly committed. So 360 million US dollars were invested into SpaceX. And also we can see that now preferred shares. Oh, common stock was here. It's not that usual. So usually they are preferring this one because it's more safer for the investor, or at least provides more privileges. Preferred shares. And still venture capital investment. 0. Why it was good for them? Okay, so maybe it was not successful. And then in the year of 2020, when they started to use the Starship in much more efficient manner, then we can see that a lot of money started to flow in. And also, Starlink satellite internet services started to become ramping up also this years. So we can see that they were reaching 1 million customers around this time. So Starlink Wikipedia. So nowadays they have a lot of satellites. Yeah, active since 5 years ago, so since 2019. And yeah, over 6,000 small satellites which are providing satellite internet. And yeah, they were reaching subscribers, 1 million subscribers in December of 2022, 1.5 million last year's May, and 2 million in last year's September. So they are scaling up rapidly. It's exponential. It's not just linear increase. So because practically you can sell your services worldwide if local governments are accepting it. Yeah. So if I know where they are not so geologged. So we can see that, yeah, this business started to lure in a lot of investments. So we can see nearly $1 billion from 2 venture capital funds. Also, that was a lot of money from different sources. Still other venture capital investors. Convertible preferred stocks were again purchased. So lots of VC. Oh my God. Yeah. 1.6 billion US dollar from an undisclosed investor. So they had to get a lot of funding. And so also at the same time, practically the debt structure is nearly non-existing. So they have a rolling credit line for 250 million US dollars with a variable interest rate, and the other is something small. Not that small, 1.5 billion, 1.5 billion US dollars, but it's a revolver line, so they don't have to take it up, it's just the upper limit. So we can say that, yeah, it can be tricky. So let's see, funding opportunities. So one option for us bond issuance. Issuing a AAA rated bond, and then we can see value, and also let's just focus on value because this is what matters for us most. So let's stay here in the inflationary stage. Maybe let's also keep the VACC because in this case we can compare. Yeah, the different scenarios, just the VACC is changing. So let's sum this thing up. Divided by 5, and then we can see average VACC. Okay. Then, what happens if we are just using loan? LIBOR plus, what was that? 4.25. Okay, then we should come back here and we should check it. Let's save it somewhere. And also we need LIBOR. So let's go for LIBOR because now we don't need any additional SpaceX illustration. So markets, money markets, because it's LIBOR, so it's London Interbank Market, and we should have the ask because we are taking up a loan here. So 3, we cannot download it. So 395, also the this is not LIBOR, this is yeah. Interbank lending rate. Unfortunately, LIBOR is removed from the market because people were biasing it actively. So now it's old product, just sometimes still companies are using it for benchmarking, but so this is the risk premium. So we can see that if we would finance ourselves through the bank loan only, then our valuation would be terrible. Variable interest rate plus this percentage. And what would be a VACC? VACC obviously higher. So yeah, higher funding costs from that or on that can create obviously pressure on variation. So this is why if interest rates are increasing, interest rate environment, then stock markets are decreasing because higher VACC will destroy the present value of future revenues. So that's a clear indication for us. Okay, but let's go back to the case study. So let's say that we still would like to finance ourselves as a bond issuance. So let's jump this here. But we are reasonable people and we know that interest rates can go up and down. But let's issue more shares. So instead of using bondholder money, if you are issuing more shares, then it means practically that we are using venture capital investment funds. So, okay, so if this one is loading in. Is there any fancy? Let's wonder funds, Draper. Let's look for Draper because they were key main investors at the beginning. So they're a venture capital company. The company seeks to acquire investment opportunities in various industries and back more than 400 companies, enterprise software, and so on. Other disruptive categories. It works with companies in seed, early and growth stages and provides financial assistance and management support in the portfolio company. So as you can see, they are not just providing investment. So they are not just saying that, okay, let's forget about the debt here. You don't have to take up a bank loan. You can get this from our investments. Yep. And then also we should not forget that now this minus 100 will disappear, so we don't have to repay it. Once they are inside, then they will be really happy. So now this is not the case anymore. Let's deactivate this. And now we can see that this is capital. So basic capital investments are popular because their added value is so not just providing money here, but also they are providing management know-how. So maybe the founder of the company is a really good engineer, but they don't have the necessary management or accounting and other knowledge bases. So that's why they start to provide management services. They are looking for managers for the company. Also, they are creating milestones for the company. So they are not just providing all the money at the same time, but as you can see it here, Draper was providing funding from year to year. So once they were able to reach one milestone, then they get the next package from the funding. So this is what is happening here. And okay, right now in this scenario we are getting all the money because otherwise we are not surviving. But still we could say that during the year they are adding more and more money, and let's not overcomplicate things. Okay, because now we can ask the question that what will be the share price? Because they are giving 100 million for us. So in terms of valuation, how much of these shares must be distributed? Because we can say that yes, we are just looking on the original data, so then we could say that, okay, they have this 27% of the shares. So we could say that, okay, there's an absolute discrepancy between the value because yeah, but possibly, okay, if we can execute this business plan, then it will be the value. So still there is a probability of absolute failure, so this is the best case for us. But still, so the question will be always that how much shares can we sell in this. So if we are really fair in share prices, then we should just dilute all these things. So this will be the old amount of shares, and this will be the new amount of shares, 1 plus. So that's 16 share. Number of shares here, so in this case we can say that one share value with venture capital investor and no debt. Maybe is divided by this one. And then multiplied it, so to get backward millions. So we can see that, yeah, if we are diluting up the share price, then this will be the effect. So if we have the VC share here, okay, let's use gray, then this additional share packages will mean that now we have a lot. So this dilution will just cut back shareholders' value. Oh. Yes. And in this case, weighted average cost of capital will be, I think, the lowest. But, so venture capital investors not just providing, not just looking for companies with huge growth potential, not just providing capital, not just providing the necessary managerial skills to improve, but also they have a window of exit. So usually they are doing business with this company for 5 years, and after that they are selling it. Because mostly venture capital funds are funded through, or venture capital companies are funded through venture capital funds, and these funds are closed-end funds. So investors, usually wealthy private persons, or pension funds and other long-term investors are investing in this fund at the beginning, and after 10 years they can only realize the return on their investment. Otherwise the fund is not liquid towards them. And in this case, the venture capital company which manages this fund has 10 years for investment. So that's why for them it's much more safer to see that, or decide after 5 years you can close down the operations. So in this case you can say that it was not turning any profit. So the DCF was absolutely useless, they were not profitable. If we are looking on tech industry, we can see that sometimes they are just profitable after 7 years or 6 years. So this DCF can be negative for all the cases. In this case, unfortunately, only salvage value will be realized. So if they are liquidating the company during the exit procedure, then that's the sad case, because it was a useless endeavor. Or they can make an IPO, so they can sell the shares through the stock market. And in this case, practically the amount of shares will be the same, just the owner will be another shareholder. So not a VC investor anymore, but mutual fund, an investment bank, other companies, someone will buy this. And of course, there are cases when they are just selling it to other companies, so without any stock market interaction, without any public listing, they are just selling it. That's all. For example, in the IT business during the 2000s, it was really popular. Just sell it to Google, just sell it to Facebook, and then they will do something with that, like Instagram or other things. So, or YouTube, for example, that you are skipping the IPO part. But here we can see that, okay, if that was efficient, then the VC profit after 5 years, it can be this money multiplied by this number minus this number. So this number minus this number, so amount of shares, and yeah, and still we have to take out the initial investment. Just right now this is in millions, so this is not in millions, this is in euros. So let's break it to 1 million, and then let's remove the initial investment, minus 100, and then we can see that we can realize this beautiful €2.8 billion. So if you are careful enough, if you can execute this investment, then our venture capital fund can realize this money, which is really nice because so we had now some nice profits, obviously. Yeah. Okay, so that's a nice rate of return, which is quite common in case of venture capital funds. So unfortunately, from every 10 companies of their investment, 2 survives only. So the rest is will be liquidated anyway, but they are really efficient, and also they are not just focusing on startups, but they are also focusing on old companies which can be recombined. So still a venture capital firm can say that, oh, let's check the assets. Do they contribute to anything? We have this intangible assets. Maybe we can sell this. We don't need this, but actually we can make some money from that one. If we would have, for example, high debt, then they would start to sell immediately the intangibles, they would start to sell immediately properties. Maybe we have business lines which are absolutely not necessary. So they would start to outsource or cut the company to pieces to identify which pieces are viable and which pieces are contributing to the profitability. So yeah, that's all. Okay, guys, so I hope that you enjoyed this part, because now we were able to see 3 different approaches how we can get funding for our company. That's all. Bye-bye.